Welcome back. In this video, we'll explain BEAT, the base erosion and anti-abuse tax. In our case study, the U.S. parent paid $275,000 of interest to its foreign subsidiary. Does this create an additional U.S. tax liability under Section 59A? Let's find out. These are the inputs we'll use throughout the BEAT computation, including taxable income, related party interest expense, total deductions, and gross receipts. We'll work through the complete BEAT computation framework step by step. The calculation flow is shown on screen. Let's begin with the first gateway test. The first gateway test is the gross receipts test. Generally, a corporation must have average gross receipts of at least $500 million. Our corporation generated approximately $24.5 million. Therefore, the corporation fails the first gateway test. Next, we compute the base erosion percentage. The result is 1.45%. The statutory threshold is 3%. Since 1.45% is below 3%, the corporation fails the second gateway test. To become subject to BEAT, a corporation generally must satisfy both gateway tests. Our corporation failed both. Therefore, it is generally exempt from BEAT. We'll continue the computation for educational purposes. Next, we compute modified taxable income, or MTI. Under BEAT, certain related party deductions are added back to taxable income, starting with taxable income of $5.434 million and adding back the $275,000 related party interest deduction produces modified taxable income of $5.709 million. Now we compute tentative BEAT tax. Applying the 10% BEAT rate to modified taxable income of $5.709 million produces tentative BEAT tax of $570,900. Now we compare tentative BEAT tax with regular U.S. tax liability. Tentative BEAT tax equals $570,900. Regular U.S. tax liability equals $1,141,140. Since regular tax exceeds tentative BEAT tax, no additional BEAT liability arises. These amounts ultimately flow through Form 8991, which is used to determine BEAT applicability and liability. In our case study, the final BEAT liability remains zero. Unlike GILTI and FDII, BEAT generally does not change taxable income. Instead, it creates a separate minimum tax comparison. Since regular tax remains higher than tentative BEAT tax, the corporate return remains unchanged. This highlights the policy difference between FDII and BEAT. FDII provides a tax benefit for qualifying foreign-derived income. BEAT serves as an anti-abuse provision designed to protect the U.S. tax base. No BEAT liability applies because the corporation failed both gateway tests. Even if those tests had been satisfied, tentative BEAT tax still remained below regular U.S. tax liability. In this case study, the corporation remained exempt from BEAT and generated no additional tax liability. The most important takeaway is that BEAT operates through a parallel minimum tax comparison system rather than directly changing taxable income. Key takeaway: BEAT focuses on foreign related party deductions. Applicability is determined through two gateway tests. Additional BEAT tax arises only when tentative BEAT tax exceeds regular U.S. tax liability. This case study was prepared for educational purposes using simplified assumptions and hypothetical facts. Always review current tax guidance when preparing real-world returns. Thank you for watching. Follow for more U.S. corporate tax case studies covering GILTI, FDII, FTC, Section 163J, Form 5471, and other international tax topics. See you in the next module.